everyone, welcome back to my channel, The Learning Path. In this video, I'm going to explain what are the classification of costs on some basis or criteria. The basis are the elements, the nature, the decisions that we are going to take, or the functions. So likewise, we can have a basis how to classify the cost as per cost accounting. Let me check the first slide. The first classification, I'm going to explain the types of costs on the basis of elements. Already I spoke about the elements of cost in the previous video. The elements of cost broadly classified into direct costs as well as indirect costs. All direct costs are collectively called it as prime costs. All indirect costs are collectively called it as overheads. What do you mean by direct costs? Let me check the explanation in this slide. These are those costs which are incurred for and conveniently identified with a particular cost unit or in the process or in the department. The cost which is directly linked with the production process. Say, for example, I told some of the examples to explain direct costs in the previous video. Say, in case you are producing a chalk piece, the limestone, which is the basic raw material to produce a chalk piece. So we could have see the final product and we can identify what was the raw material made use of for producing the chalk piece. So that limestone cost is the direct cost. But for production of chalk paste, we need a factory, and the factory has to be taken care by the watchman or the gatekeeper, or the godown has to be taken care of the storekeeper. So they are not directly engaged in the production of commodity. They are the supporters. Okay. So whatever salary I am going to pay to my gatekeeper or the storekeeper or any kind of benefits that I'm going to give, so these are all comes under indirect costs, where you cannot identify those costs in the final product. So please check the meaning. Indirect cost, it's a general cost and are incurred for the benefit of number of cost unit. It is incurred for group of unit. It cannot be identified with a particular cost unit. Example, depreciation, rent, salary for the gatekeeper or the storekeeper. Okay, but the foreman salary, the supervisor salary, all comes under direct costs because they are directly engaged in the production of commodity. Again, I am explaining this thing about the direct cost and the indirect cost in this video also. I discussed the types of cost as on the basis of elements also in the previous video. Next is period costs. The period cost, I can say, it is not relevant for the production and incurred even if there is no production. I can take the same example, watchman's salary. The factory watchman's salary is the best example of explaining period costs. Okay, it remains fixed whether the factory is in lockout. Suddenly the factory is facing a lockout due to strike or the raw material non-availability of raw materials or power shutdown. So based on these reasons, the production may stop. But we can restrict the salary in paying the salary to our laborers because they are not engaged in the production of commodities. So we can stop paying the salary to the labor, but at the same time, we cannot restrict in paying the salary to the gatekeeper or the security because whether the production is there or not, or the production is nil, we need to incur some expenses. Those expenses are called it as period cost. It is a fixed cost. It is not necessary for production and incurred even if there is no production. So this is the exact meaning of period cost. Whether the production is there or not, you may incur some expenses. That is standard, that is fixed, that is static. You cannot change it. So those costs are collected or call it as period cost. Okay. The next is opportunity cost. What is opportunity cost? It is a cost that measure the benefit that is lost or sacrificed when choice of one course of action required that other alternative course of action be given. I can say very easily opportunity cost is the opportunity lost. Please look at this example, which I gave it in the slide. A company deposits 1 lakh in a bank at 10% interest per annum. Now, the second proposal is to invest this amount in debentures. The debenture rate of interest is given in the brackets. 1,000 debentures, 17% of rate of interest. Each debenture value is 100. The solution, look at the solution. If company invests 1 lakh in debentures, they decided to invest in the debentures. Then how to calculate the opportunity cost based on this example? Then 17,000 minus 10,000. What is 17,000 means? What is the amount of interest that I'm going to get, that because I'm going to invest the amount in the debentures, that is 1,000 into 100 into 17 percentage. So the amount of interest I'm getting if I'm going to invest in the debentures is 17,000. In case the same amount is going to deposit in the bank means I could have get interest of 10,000 per annum. So what is the opportunity cost behind this decision means? That is 7,000. That is 17,000 minus 10,000. 7,000 is the opportunity cost. This is the opportunity loss as per the definition. Next is relevant cost. Relevant cost or irrelevant cost. I want to explain this type of cost through a small example. Say for example, if you want to travel somewhere, okay, if you want to travel from to any place, you may have three options. Either you can go by car or by bus or by train. If you are not going to consider the traveling expenses, you want to be comfortable in traveling, you want to be feasible in traveling means the traveling expenses is irrelevant cost for you. At the same time, I'm considering the traveling expenses, whether traveling expenses is as per my ability to pay. Means that traveling expenses are relevant costs. So based on the relevance, what we are going to give, the important decision that we are going to take. Well, in case the traveling expenses is relevant cost because I'm considering that traveling expenses is important to decide whether I want to go by car or by train or by bus. At the same time, a rich man, where he needs only comfortability, he needs to be very feasible during his traveling means he could not consider this traveling expenses. As per him, these traveling expenses are irrelevant costs. So this is another type of cost as per relevance. Next is sunk cost. A sunk cost is a cost, that is an expenditure made in the past, but it is not relevant to the future decisions. These are all the costs will based on the decision making. Okay, it has occurred in the past, but it is not relevant for the future decision making. That is called as sunk cost. So look at the same example. There is an example given in that slide. If a firm want to purchase a new plant, the firm want to purchase a new plant, then loss on sale of old plant is a sunk cost. See, earlier they bought one plant and they sold on the base of say loss. When they were selling that plant, they faced some loss. That loss on sale of plant was irrelevant and it is not relevant for taking a decision to when I'm going to purchase a new plant. So whatever cost incurred in the past, it is not relevant for taking a future decision means that cost is called it as sunk cost. Okay. And next is out of packet cost, otherwise called it as explicit cost. And just opposite to this type of cost is implicit cost. Implicit cost, there are other names, that is notional cost or imputed cost. Let me check what is the meaning of explicit cost or out of packet cost means. These are the costs which require cash payment to be made immediately. Okay, we cannot delay in paying those expenses. That is called as what is that out of packet cost or explicit cost. But imputed cost or notional cost or implicit cost is these are the costs which is not actually incurred, when we are carrying out the production process. Okay, I can give some example. If I am running a company on my own, okay, there are certain expenses I could have incurred. Say, for example, if I am running a company in my own building, means there is a in my say for example, another example I can, if I am running a company in my friend's place, means I could have paid some rent on building. And if I'm going to recruit a person to say for example, the company is a mechanic shop, the company is a mechanic shop. See, I'm running a mechanic shop. Okay, if I'm running a mechanic shop in another one's place, means I could have paid rent. If I'm recruiting a mechanic to take care of the work, means I could have paid the salary. And then for running a mechanic shop, I need some investment. Okay, to take care of the initial expenses to set up a mechanic shop. Okay, so either I can get the investment either from the bank or from friends or from relatives, but I need to pay some interest on the capital that I'm going to get it from my friend or my bank or any other sources. But if all the things will bear by me, say for example, I am running a mechanic shop in my home itself. Okay. And moreover, I am the mechanic, as well as, say, for example, I am putting my own capital. Okay. So these are the costs which is not occurred actually, but we need to consider to know the economist point of view of profit. Okay, so these are the costs not actually incurred, but it is calculated for taking a correct decision. You will, I think most of them studied in business economics. There is two different points of opinion about the profit. As per the accountant point of view, we need to consider only the explicit cost. Whatever cost we that is we incurred, we are paying, that is alone is considered, and they will find out the profit. That is a profit as per the accountant point of view. But as per the economist point of view, they not only consider the explicit cost, but also consider the implicit cost, not to know the profit. And this profit will lead the company to sustain in the future. So these implicit cost is otherwise called as notional cost or imputed cost. Those costs are not actually incurred, but it has to be considered to know the correct profit as per the economist point of view. I can give the examples are all rent on own building, salary for the proprietor, and then I can say um, interest on my capital. So these are all the costs which is not actually incurred. I'm not going to pay, but it has to be considered to know the exact profit of the company or to survive in the future. So this is the thing I want to highlight. This is very important term, imputed cost or a implicit cost. And next is conversion cost. What do you mean by conversion cost? Conversion cost is a combination of, I can say, direct labor, direct expenses, and factory overheads. So conversion cost is the cost which includes direct labor, direct expenses, and factory overheads. So I can say direct material is not the part of the conversion cost. It considers only the direct labor and then direct expenses and factory overheads. Look at the slide. Conversion cost, it means per unit cost minus direct material cost, or it means sum of the direct labor and factory overheads cost in the production. Conversion cost is the factory cost minus direct material cost. Okay, you can look at the diagram which I gave it in the slide. Through this, you can clearly understood what do you mean by conversion cost. So direct material, direct labor, direct costs are all prime costs, are all prime costs. And then prime cost is the combination of direct material, direct labor, and direct expenses. But the conversion cost is the combination of direct labor, direct expenses, and factory overheads. Okay. The next is product cost. What do you mean by product cost? Which is these are the costs which is which are very necessary for the production, and which will not be incurred if there is no production. If the production is nil, means the product cost also will be nil. Okay. So product cost is the combination of direct material, direct labor, and factory overheads. And next is normal cost. Normal, there are based on the normality, we have normal cost and abnormal cost. What do you mean by normal cost? Is normal cost is the cost which is normally incurred on expected lines during the production. Okay, manager commission is expected 5,000. I can say that is 10% of the selling price, but it is 6,000 because the sale quantity may, if it increases means the manager commission also may increase. So this is an example I can give the normal cost. Okay. Next, just opposite to the normal cost, this is abnormal cost. Normal cost, I can say, which is influenced due to the specified member of the undertaking. But abnormal cost is not like that. It's a cost incurred due to abnormal reasons. It is over and above the normal cost and treated as part of the cost of production. You can understand the normal cost and abnormal cost is a normal cost, you can say it can be incurred only because of the specified reasons. Okay, but abnormal cost, because of unexpected reasons, we can, that is, say, for example, in this slide, I gave the examples: loss by fire, theft, strike of employees. These are the unexpected things, uncertain things. Anytime it will occur. So it is called it as abnormal cost. Okay. Next is very important terms in the cost accounting: fixed cost. What do you mean by fixed cost? What do you mean by variable cost and semi-variable cost? In this slide, I try to explain what is a fixed cost means. It's a cost which remains constant whatever be the volume of production. I mean, if your production is, even if your production is zero, or even if your production is at an increasing rate or at a decreasing rate, your cost remains constant whatever be the volume of production. Again, I can give the example: the watchman's salary. Whether production is zero, or the production is at high level, or the production is at a low level, I'm going to pay the watchman's salary as 10,000 means that is fixed cost. Okay, so I can give the explanation. Fixed cost is the fixed cost which remains constant whatever be the volume of output. It is a cost incurred for procuring the fixed factors of production. I can give the examples: land, machinery, buildings. These are all the fixed factors of production. Okay, in the short period. Only these classifications will valid in the short period, not in the long period. This fixed cost, variable cost, these are all valid only, again I'm telling, valid only in the short period, not in the long period. So all the fixed factors like land, labor, sorry, land, building, machinery, these are all the fixed factors. Okay. So whatever money and that I'm going to spend for procuring these fixed factors, or call it as fixed cost. So again, I'm telling fixed cost remains constant, whatever be the volume of production. Okay. So look at this slide. I gave the examples of salary, taxes, insurance. And one more thing I want to add on this point, that is in the first column, I gave units, number of units produced. The second column, I gave fixed cost, and the third column I gave fixed cost per unit. Okay, so the fixed cost per unit, that is, when I'm going to produce one unit, my fixed cost is 20,000. Fixed cost per unit is 20,000. How I get total fixed cost? The second column is call it as total fixed cost. The second column is call it as TFC. Okay, so TFC divided by number of units. For the first instance, I produce only one unit. So 20,000 divided by 1. What is the cost per unit? Fixed cost per unit, 20,000 rupees. Okay. The second instant, when I'm producing 2 units, what is my fixed cost per unit? 20,000 TFC, 20, the second column, TFC, 20,000 divided by 2. Then what is the fixed cost per unit? 10,000. Okay. In the third instance, when I'm going to produce 20 units, look at the change. 20,000 divided by 20, what is the fixed cost per unit? 1,000. When I'm going to produce 200, the fixed cost per unit is 100. When I'm going to produce 2,000 units, look at the fixed cost per unit has become 10. How it become 10? 20,000 divided by 2,000 rupees. So you will come to one conclusion by analyzing these three columns. TFC remains constant. Look at the second column. TFC remains constant at rupees 20,000 whatever be the volume of production. Look at the first column. First column is the volume of output, and second column is TFC. TFC remains constant, whatever be the volume of output. But AFC in what do you mean by AFC? Fixed cost per unit. AFC will vary as per the volume of output. If your production is more, means the AFC will be less. If the production is less, means the AFC will be more. You can apply this concept when I'm explaining these three columns. Again, I'm repeating, TFC remains, the second column remains constant when the volume of production is zero, or it is increasing, or it is decreasing. But AFC, that is fixed cost per unit, will vary as per the volume of output. When AFC will be more, when your production is less. When AFC will be less, when production is more. So have an understanding. This theory basic is very important in marginal costing technique as well as in budgetary control. Next is uh, I want to explain somehow on the fixed cost. It's expenses incurred on fixed factors which does not change with the change in level of output over a given period of time. I gave the examples of fixed cost. It has no effect with the change in the level of output. It is also known as indirect cost. Okay, I given a diagram for how to draw a fixed cost curve. Those who studied business economics, you very well understand this diagram. OY axis is the cost, OX axis is the output. I drew a fixed cost curve which is parallel to OX axis. That means if your production is zero, if your production is high, if your production is low, but the fixed cost, say for as per our example, is 20,000. So 20,000 is remains constant on my OY axis, whatever be the volume of production. That's why the fixed cost curve has got the shape that is parallel to OX axis. That means the total fixed cost remains constant, whatever be the volume of production. Okay. The next is variable cost. It's just opposite to the fixed cost. Variable cost will be zero when your production is zero. Variable cost will be high when your production is high. Variable cost will be less when your production is less. So we can come to a conclusion. What do you mean by variable cost? Means it's a cost incurred for procuring the variable factors. What are the variable factors? Raw materials and labors, which is useful for production of the commodities. When we need more raw material and labors, when our production is more. When we need only less amount of materials and less number of labors, when we restrict our production. When we need more or no materials, no labors, when production is zero. So you can come to a conclusion. What do you mean by variable cost? Variable cost will vary as per the volume of output. So variable cost will vary proportionately. Proportionately, that means it will increase when production is increasing. It will decrease when production is decreasing. It will become zero when production is zero. So it will vary in a proportionate level when the production is increasing or decreasing. So what are the examples I told you? Direct material costs or labor costs. Look at the diagram in the slide. Initially, there is a variable cost will increase when production is increasing. Variable cost at the initial stage is zero because my production is zero. So this is an explanation for the variable cost curve. Okay, it's also known as direct costs. And semi-variable cost, you know very well, to some extent, though it will be remain fixed. After that, it will vary. That cost is called as, what is that? Semi-variable cost. So it includes both fixed portion as well as variable portion. Up to one limit, the fixed, after that it will increase, the quantity of production is increased. Say for example, supervisor salary, telephone expenditure, electricity expense. Electricity expense is the best example I can give to explain the semi-variable cost. To some extent, it remains constant. When you are crossing the limit, it will vary as per the meters, isn't it? So that is the best example to explain semi-variable cost. And shutdown costs. These are the costs which will be still be incurred although a plant is shut down temporarily. Rent, rates, depreciation. So even the company is in lockout, the company is not producing anything, but we may incur some expenses like we need to look after the machineries, whether it is in working condition, that whatever costs incurred, that is in the name of repairs and maintenance, and we need to give rent for the factory, isn't it? So these all comes under shutdown cost. Next is based on control or based on control, we can have controllable cost or uncontrollable cost. Uncontrollable cost, this is the cost it cannot be influenced by the action of specified member of an undertaking, or known as uncontrollable cost. Almost all costs are controlled by some level of management. But if it is controllable, when the amount of cost is incurred can be influenced by the action of the specified member, means it is controllable cost. I gave examples. We come to know what do you mean by controllable and what do you mean by uncontrollable. Examples for controlled cost is advertising, direct material cost, donations. These are not that is controllable cost. Uncontrollable cost examples I gave: rent that a landlord charges for the use of company's premises. Okay. I think from this video, you will come to know what are the classifications of cost based on some criteria or based on some basis. Okay. So with this theory background, we can work out problems and more understanding on the cost accounting. If you like this video, please subscribe and share this video to your friends and other college students also. Click the bell button, then only you will come to know what are the new videos I'm releasing in my channel. Thanks for watching. See you again next video. Till that time, please, this is my advice and request to all the persons one who is watching my videos in YouTube. Stay home, stay safe. Thank you so much.